Hello there, and welcome back to the Surrogate Dad podcast. Today we're going to cover investing. Now, investing is a complex topic, so we're not going to be able to cover it all in one episode. It's going to be I don't know how many episodes, two, three, four, five, six, 20. I don't know. We'll do one or two episodes right now. Um, I've got to do an episode on changing a tire, so stay tuned for that one, and we'll show you how to change a tire. My niece asked for that one, and so that one gets near the top. But I thought I'd take a break from automotive for a bit, and so we'll do a couple episodes on investing, get you started. So, first thing, gotta say, remember, I'm a dad, not an investment professional, and so this is not professional advice. This is dad advice. And if you're not sure about anything, always seek a professional. But Dad's done some good studying over the years into investing. I did take the Canadian securities course some years ago, never did get licensed. But dad's done I've done all the investing for our family for 30 some years, and we've done pretty well. Done pretty well. So without further ado, let's get into it. First thing Dad's got to tell you, you must invest. Not you should, you must invest. The day's going to come, you're going to have gray hairs one day, and don't count on the government taking care of you. Don't count on anybody taking care of you. The only person you can count on is yourself. So, now your first objection, but I can't afford to. And Dad gets it. I understand how tough things are these days. Things are really, really tough on younger generations, and there's no way around it. Well, there is a way around it. There's one way around it. You've got to take care of yourself. So you must invest, even if you I can't afford to. Yes, you can. There are apps you can get. You can buy one stock at a time. There's a fellow I used to work with a couple of years ago, and young fella, and he started out buying one stock at a time. So maybe this week it was a $5 stock. Maybe next week it was a $25 stock. Maybe next week a $10 stock. Maybe a $50 stock. But he would buy one stock at a time. So you can do that if you really, really have to, but you must. So get an app if you can't afford it. Get an app that will allow you to buy one stock at a time and do it. I hope you can do more. And what you will find is as you go and you put 25 bucks a week or a month or whatever into it, and pretty soon you'll realize I can get by without that money. You naturally adapt your spending for that little bit of money. And then maybe you'll be doing $50 a week or $50 a month at some point, and then maybe 100. And so that's probably the first lesson. That's actually the best way to invest. When you invest every week or every month, you buy a stock, 100 stocks, 10 stocks. That's a thing you're going to want to know called dollar cost averaging. And here's how dollar cost averaging works. All right, so let's say you decide to invest $100 a week and you want to buy this stock A. And week one, stock A is at $50. So how many do you get? You get two of them. But then week two, the price goes up to $100. Woo, you made some money, great. But now you're spending $100 a week, you only get one stock. Next week, it goes back down to 50. Aw, darn. You get two stocks. Next week, it's back up to $100 again. You're spending $100 a week, remember, right? So week four, you get one stock. At the end of 4 weeks, you have six stocks, and your average price is $75 per stock. Wrong. Because you get more stocks when the price is lower and less stocks when the price is higher, your actual average cost per stock is only $66.66. So, dollar cost averaging, great way to invest. You're spending the same amount of money each month or each week or whatever time period you choose, But because you get more when the price is lower and less when the price is higher, it actually drives down your average price for stock. So there's dollar cost averaging, a great way to invest. So there you go. There's your first tip. So remember, you must invest, not you should, but I can't afford to. You can't afford not to. You must. Even if you can only afford one stock or $100 or whatever, no matter what it is, you must invest. Now, Dad's approach, which you're going to see over several episodes, is a get rich slow scheme. You're not going to get rich quick. If you get lucky, you might, but you're not likely to get rich quick. But you will get rich. Eventually, when you get older, you will have good money. You'll have you will have money saved up, sufficient money, if you invest wisely using Dad's tips. You will have a significant sum saved up over time. So it's a get rich slow scheme, but it's a get rich for sure scheme. In a nutshell, as we'll see over several episodes, my investment style, I found out quite by surprise, is actually very close to the Warren Buffett style of investing, a kind of value investing, but we'll get more into that in later episodes. Right now, I just want to give you the basics. Now, fair warning, you're going to watch your stocks go up slowly, slowly, slowly for years. It's just going to be a little bit, a little bit, a little bit, and you're going to be going, oh, I'm never going to get anywhere. One day, you'll start to notice my stocks are kind of going up a little quicker, just going up a little better. And then a couple of years later, you'll start to notice, whoa, they're going up even more and more. And pretty soon you'll notice they're going up at a pretty good rate. And that's because of the compounding effect of interest or of return on investment. One of the things we're going to talk about is reinvesting. That's one of the things that'll come up. But by doing some of the things Dad shows you, your investments the return will compound on each other and basically mean it increases your return. And over the years, pretty soon one day you're going to start to see it going faster and faster. So that's some years down the road. So you need to remember for years to come, it's going to be slow going, but it will be going. And it will come. One day you'll have gray hairs, and one day you'll go, oh my gosh, that's great. So, and now remember, I think this is from one of the Godfather movies, but I'm not sure. Remember, pigs get fat, but hogs get slaughtered. So I don't know where it's from. I think it's from a Godfather movie. But anyways, don't get greedy. Don't get too greedy. Okay? Okay, so let's handle some of the fears about investing. What you're going to see is Dad's going to recommend investing in the stock market a lot. I don't know a lot about bonds, but what I do know about bonds is I don't see any reason why to get into them. So there's a wide enough variety of stocks available to you, and don't worry, Dad's not going to recommend you get into crazy stocks. So first question, well, what if the market crashes? Good question. Market crashes from time to time. Get in there and buy some more. If you go back and you look at the history of, say, the Toronto Stock Exchange or the New York Stock Exchange or in your country, whatever stock exchange there is, if you go look at the history, you're going to see that there's a lot of times when it crashes, but it comes back up again. It always comes back up again. And if it didn't, if the stock market crashed and never came back up, then the world's in you're going to have worse problems than worrying about your investments. If the world is in that bad of a situation financially, you're going to have a lot more to worry about than your investments. So, yes, the market crashes, but so far throughout all history, it recovers. And the stock market crashes are actually great buying opportunities. Here we have a chart of the Toronto Stock Exchange, the main stock exchange in my country, and this goes back all the way to 1972, back when Dad was a kid. that you weren't even thought of yet. So I want to show you a couple things on this chart. Look how it goes up and then boom, down. That was a big down back in 1975. And then look at how it jumped back up again, stayed stable for a while, and look at that. From the late 70s until about 1980, it went up, 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 up. But then look at this, crash down in the early 80s. But look at that, right back up again. Boom, a little crash, up, 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 and then bam, one day, look at that. And then, but look at this, up, 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 and then crash, stable, up, 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 up. Now look at that. From 1987, 88, it took until 1993, 5, 6 years to get back to where it was. For those 5 or 6 years, you had lost money. You didn't get back to where you were here for 5 or 6 years. It took until about 93, 94 to get back to where you were in 87. So there's so many lessons in this graph. This 5 year period, can you imagine you'd have been sitting there going, oh, if I can find Dad, I'm going to get him. But if you'd have just hung on, look at that. Up, 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 boom. Up, 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 down. Up, down. Look at that. That's, where's COVID? 2000? When was COVID? 02? I don't even remember when COVID was anymore. Oh no, COVID is like 2024. This only goes to 2006. Anyways, down it went, up, 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 up. And I don't know, and right now let me check and see where the market is at. Right now, the stock market is over 27,000. Look at that, double of where it was not even 20 years ago. So can you imagine if somewhere in here you're going, oh my gosh, we're losing money, I'm bailing, I'm out of here. So there's a few lessons in here. First lesson, investing in investments in stocks is a long-term investment. It's a long-term thing. There's going to be times when it goes down, and we're going to show you some strategies over the next few lessons, depending on your risk level. You're going to have to define for yourself where you can sleep at night, what level of risk you can handle and not lose sleep. And that's how you've got to invest. You've got to stay within that range. So that's one lesson. Another lesson is, see these purple lines here? These are what are called levels of support, and this upper line is levels of resistance. All it does is charting out ups and downs, but notice how with all these ups and downs, there was over the long term a steady upward trend. Okay, so, but some of you may have thought of this already, but look at this, when the stock market goes down, big downs, you get in and you buy. If you get whatever extra money you can afford safely and you go buy some stocks, whenever the stock market crashes like this, you go and you buy. Now, remember I talked about dollar cost averaging? Here's what Dad does. I'm not saying it's the best. This just works for me, and these are ideas. But when a stock market is down like this, you never know when the bottom is, right? Like, look here, it dropped and it started going up again. So you might have said, oh, we better get a bunch of money in because it's going up. And then all of a sudden it goes down. So what I do is I do a similar kind of a thing to dollar cost averaging. If let's say I had $20,000 to invest. Right here, after this drop, I'd invest $5,000 maybe. And then it goes up a little bit. I might have invested another $5,000 here. Boom. Somewhere around here, I might have invested another $5,000. Then it starts creeping up, and I might have invested another $5,000 around here. So that way, I don't know where the bottom is, and I don't know where the top is. So I'm kind of playing it safe. But either way, I still get a lot of good stocks at a good price. So there's a lesson for you. Buy. It's like the old saying they say is, if a shirt goes on sale, do you say, oh no, I'm not buying that shirt? No way. Of course you get in there and you buy it. It's on sale. Why not do the same with stocks? And that's another thing, is it's very dangerous to buy when the market's hot and everybody you know is saying, you got to get in, it's going crazy, it's never going to end. Yeah, it's going to end. Whenever you hear things like that, it's never going to end. Good times. Those are times you want to be really careful. There's an old saying, I forget exactly how it goes, something like when the cab driver's giving you advice on what stocks to buy, who's left? It's called the second last fool theory or the second last sucker theory, where the well informed people in the market, the stockbrokers, the wealthy people, they're going to be the first to know. If I'm a stockbroker and I want to make some money, I'm going to call up my clients that have lots and lots of money. And so slowly news gets down to people. When it gets down to people like you and me and the cab driver, it's pretty much the end of the good times. So you want to be the second last sucker. You don't want to be the last sucker. So be careful when things are hot, and good times are never going to end. That's why things like dollar cost averaging and dads, how when the stock market drops, I'll buy some and then some more and some, just kind of balance my risk and my reward out. So there you go. So we're talking about what if the market crashes? Well, hopefully I've answered that, but here's another question. What if it doesn't? And if you notice in the history of the stock market, it goes years sometimes without crashing. Okay? So remember, what if it doesn't? Get in there and get invested. Here's another question for you. What if it does, and what if it recovers? So far we've seen throughout all history, it always does that. And like I mentioned before, if it doesn't recover, you're going to have a lot more to worry about than your investments. And by doing some wise investing, that'll actually help you to mitigate some of the trouble that would be in if the world ever gets to that situation. What if I pick the wrong stocks? Good question. You're going to pick some wrong stocks. Everybody does. If you have a friend that tells you they never picked the wrong stock, they're fibbing to you. Everybody picks some wrong ones. Don't worry about that. In another episode, we'll talk about how to buy some good stocks. Basically, where do we stop with the what ifs? What if purple aliens come down and they eat me? We can think of a million what ifs. You got to get in. You got to, it's. I think it's in Winnie the Pooh. I think, is it Eeyore? Or someone says, Winnie, they're in the forest. What if a tree falls on us? And Winnie says, well, what if it doesn't? So you always want to be prepared. You want to prepare for the worst, and we'll talk about that in other episodes. But you want to live for the best, because most likely that's what's going to happen. All right, so let's talk a little bit about buying the wrong stocks. What if I buy the wrong stocks? There's a few things I'll show you, but today let's just talk about diversification. Diversification helps with that, and that is basically you don't want to have one or two or three stocks and you've got all your eggs in one basket. And you don't want to have 150 stocks either. You can do the research on your own, but you get different people will say 22 stocks or 30 stocks or 12 or 50 is the right number of stocks to have for diversification. And I don't know the answer to that. I would say, I guess as many as you can reasonably keep track of, but if you're buying a stock just because, I want to diversify, you're buying it for the wrong reason. It has to satisfy the qualities of a good investment. You have to look at it and say, regardless of everything else, I would buy this stock. So you don't diversify just for diversification's sake. Diversify wisely and pick only good stocks. And we'll talk about good stocks over these few episodes. Okay, and let's do a little introductory talk about what are good stocks. I won't be able to show you those things today, but here's some things to get you going, get you started. So, what are good stocks? Well, my definition of good stocks are ones that will give me the best return I can get with reasonable risk. Now, of course, we have to define what's the best return and what's reasonable risk, and that's hard to do. Only you can define reasonable risk. Reasonable risk is as much risk as you can handle, so when things go bad, you can still sleep at night. If like for example, let's say grocery stocks. Grocery stocks traditionally don't go up a lot and don't go down a lot. People eat what they eat. And so traditionally they don't vary a lot. They're a fairly safe stock and you won't lose much sleep with them. But you won't make huge returns either in the long run. Okay? uh, technology stocks. You might get some huge returns, you might get some huge losses. So those are two very different examples to illustrate for you. So you got to sit and think about how much risk can we handle without losing any sleep at night? What's the best return I can get? Well, I suppose in the long run, you'll, historically speaking, anywhere from 8% to 20% per year, anywhere in there is a reasonable return. 20% is a great return. If you can get that, that's fantastic. And I can show you, so we will show you some tips that'll help you move toward that in the long run. We'll show you some tips that will give you the best you can really hope for, is to just match the market. There are hundreds and hundreds of professional investment advisors that cannot beat the average, cannot beat the market. And so to think we're going to beat the market, that's a tough job. That's a tough job. So that might be a good initial goal for you to set is, I just want to meet the market, do the same as the market. And you could do that really easy. There's things called index funds where they buy stocks that match the market, and then they tend to do pretty much similar to the market. And you can just forget about them. So that's one strategy. But anyways, a good return to look for is somewhere around market average. And then as you get more wise with your investing, you may make different goals for yourself. But one thing you must do is you must beat inflation. You go and put your money in the bank in a savings account. What do you get? 0.2%? Let's say they gave you 2%. Let's say you actually found a savings account with 2% or a bank savings bond with 3%. Well, they pay interest. And in most Western countries, interest is the most highest tax form of investment return. You pay the most tax on it. And after you finish paying your taxes, when you account for inflation, you may have lost money, or at best, you may have made no money at all, because the taxes eat a portion of your return, and then you also got to look at inflation. You've got to beat inflation. So you definitely, minimum rate of return you got to be aiming for is you've got to at least beat inflation after taxes. And that's not even a goal, that's a minimum. Regarding risk, you'll have to set your own risk level, but remember, the closer a stock is to bingo, the more risky it is. And I don't advise, that's not investing, that's gambling. If you're going to buy stocks that are really, really risky, you may as well go play bingo because you got the same odds. And don't even think about market timing. Market timing is trying to time the right time to buy a stock and the right time to sell a stock. Don't even think about it. Maybe when you get sophisticated, you might want to do that, but if you do, Dad's coming for you. Dad's advice, don't ever do that. Unless you may find, I love doing this and I want to do this. I want to do this every day. So I knew a guy who retired, and that's what he did for his income is he did day trading, where you're buying and selling stocks every day. Dad, I buy a stock, I might buy 5 stocks a year maybe, and I rarely sell them. I buy good stocks, and if they go down in price, I buy some more. And then I just hold them, and I reinvest the dividends. So we're going to talk about all those things. But my dad's philosophy is buy good stocks and hang on to them and buy more when they're on sale, reinvest the dividends. So I'm giving away the whole farm here in one episode. So I think that's enough for the first episode. So let's give you some goals. I want to give you 3 goals until the next episode. First goal, think about risk. Think a lot about risk. Think about if your stocks went down for a while, would you lose sleep? Could you live with it? Think about that a lot. And when you're thinking about risk, Dad's going to show you some things to help you mitigate, to help you lower your risk. Like I talked about dollar cost averaging, diversifying into several different stocks, not putting so much money into stocks that if you lost it all, you're broke. So all those kinds of things. But think about those things. Think about your risk level. Then figure out your minimum weekly or monthly investment amount, what it's going to be. Set that goal. Figure out how much it's going to be. And then your third goal for this episode is either set up an online brokerage account with one of the self-managed low-fee brokerage accounts, or find an app and get into one of those apps that allows you to buy one or two stocks at a time. And so those are your three goals I want you to set up. And if you feel comfortable, you can buy a couple stocks. If you're buying $5 or $10 or $20 worth of stocks or $50 worth of stocks, nothing, the world won't end if you lose that. I can't give you any advice on buying stocks in this short a time period. For now, if you can't wait and you want to buy a couple stocks, buy a name you know. Buy a company that's got a good name. Buy something that's been around a while, that just feels safe, feels good, feels professional. You know, don't buy any of these companies that's got, at least not yet, unless you put very little amount of money into it. Don't buy these companies that's got the latest, greatest, newest thing, and the future is great. We're going to talk about that. There's a lot of dead bodies along the road to the future is great. So we're going to leave it at that for this week. And next episode, we'll get into a little more depths. And then maybe we'll do one more, or we'll go into changing a tire. So there's what's coming down the pipes. So remember, Dad loves you, and listen to your mother. See you next episode. Bye.